Ever get that feeling there might be ways to potentially grow your money that just aren't really talked about much?
Yeah, things that fly under the radar.
Exactly. Well, today on the deep dive, we're sort of pulling back the curtain on one strategy like that, carry trade.
Right.
It might sound a bit, I don't know, abstract at first,
Yeah,
but stick with us because it really touches on some fundamental things in global finance.
it really does. And, while you might not hear carry trade dropped in everyday chats in Vietnam right now globally, it's a pretty significant play.
Okay.
At its heart, it's simply taking advantage of different interest rates, different countries, different currencies, different rates.
Right.
The basic idea is borrowing money where it's cheap, think low interest rates, and then investing that same money somewhere else in a different currency and its assets where the interest rates are, much higher.
Okay, so find cheap borrowing, chase higher returns somewhere else. Makes sense on the surface.
hmm
You mentioned its global impact. Can you give us a quick, real-world example of how this might play out for our listener?
Sure. Think back to early August 2024. Remember when the Bank of Japan, the BOJ, made that tiny adjustment upwards to their interest rates? They'd been ultra low for
Yeah, I
ages.
remember hearing about that.
Well, even that really small move sent ripples, globally.
Right.
We even saw a bit of a dip in the Vietnamese stock market. Why? Because some international investors reacted.
Ah, uh,
See, a lot of carry trade strategies use the Japanese yen precisely because of those super low rates historically.
right, the cheap borrowing source.
Exactly. So even a minor policy tweak in Japan can make investors rethink their positions, maybe unwind trades, and that triggers broader market moves. It just shows how interconnected everything is.
Wow, okay, that really drives it home. The small change there, tangible effects here. So for this deep dive, what are we going to unpack for the listener today?
Right. So we'll get into the nuts and bolts. How does carry trade actually work? What drives the profits? And crucially, what are the very real and significant risks involved?
Okay, risks are key.
Definitely. We'll also look at the kinds of environments where this strategy might, be considered, touch on some history, some past episodes where carry trade was a big factor in market bubbles.
Right.
And yeah, ultimately try to give a sense of what this all means in the bigger picture, the broader financial landscape.
Sounds like a solid plan.
Uh,
And for listeners who want to dig deeper, we looked at sources like that top PI article from October 31st, 2024, Carry Trade Lucky.
which translates, as we said, to what is carry trade, operating mechanism and risks to know. Good overview.
Yeah, so let's start right there. The fundamental question, what is carry trade, maybe in a bit more detail?
Well, as that 2.pi article lays out, it's essentially a strategy in the foreign exchange market, the Forex market. It's all about exploiting those interest rate differences between currencies that we mentioned. You're leveraging the fact that borrowing costs might be really low in one currency,
Mhm.
while the potential return from saving or investing in another currency is much higher. The profit, at least in theory, comes from that gap, that difference.
Right, the spread between the borrowing cost and the investment return.
Mm.
The article really highlighted the Japanese yen. Why the yen specifically? What makes it so popular for this?
Ah, the yen. Yeah, it's been the go-to funding currency for carry trade for a long, long time. Since about 2005, Japan's kept this policy of really low interest rates. Think like 0% to maybe 0.5% per year.
Wow, that is low.
Super low. And that long stretch of cheap money led to what the article called a significant trend, investors borrowing loads of yen to then go invest in countries offering much better interest rates.
So it's like getting access to super cheap funds in yen and then putting that capital to work somewhere you can earn a much higher yield. The article even mentioned a Bloomberg quote, like borrowing cheap in Japan to buy, Mexican bonds yielding over 10%? Or even NVIDIA stock or Bitcoin. That's quite a range.
It is. And as the 2PI article points out, things got even more interesting when the yen weakened against other currencies sometimes.
Right.
Or back in 2016, when the Bank of Japan actually tried negative interest rates, that basically made borrowing yen even cheaper, making those carry trades look even better on paper.
But there's always a but, isn't there? The article also brought up that BOJ rate hike in August 24 and worries about the U.S. economy slowing down
Mm.
as things that triggered a global asset sell-off.
Mm.
How does that show the the flip side of carry trade.
That's a perfect illustration of the vulnerability. When the basic conditions making the trade profitable start to shift, like the cost of borrowing yen maybe going up even slightly,
Oh.
or maybe more uncertainty creeping into the places you've invested, like the U.S. markets. Well, investors who've built up these trades often move fast to get out.
Unwind the position, right.
Exactly. They have to sell the assets they bought, maybe those Mexican bonds or whatever, and buy back yen to pay off their loans. That selling pressure hits the assets, and the yen buying pushes its value up, potentially hurting the trade even more as they exit.
And these trades often involve borrowing a lot, right? Leverage.
Huge point. Carry trades are often highly leveraged. That means even small moves in interest rates or, crucially, exchange rates get magnified. Big potential gains, yes, but also big potential losses, which forces that rapid unwinding we talked about.
Okay, so borrow low, invest high, profit from the difference.
Yeah.
But you are really exposed if rates shift or confidence drops.
Got it. Now let's dig into the mechanics. What are the actual steps? How does someone do a carry trade?
Okay, so generally it breaks down into a few key stages. First step, borrowing. You need to borrow capital in a currency with a low interest rate. We mentioned Japan, Switzerland, they've often been the place.
Step one, get the cheap money. Right. Step two, conversion. You take those borrowed funds, say yen, and you convert them into a currency that offers a much higher interest rate. Think, historically, maybe the Australian dollar or the New Zealand dollar.
Okay, borrow low-rate yen, swap it for higher-rate Aussie dollars. Then what?
Step three, investment. You invest those Aussie dollars in assets in Australia. Could be government bonds, maybe corporate bonds, stocks, or even just holding the currency in a high-yield deposit account there. The goal is to earn that higher Australian interest rate.
And that's where the profit starts ticking up, hopefully.
Hopefully, yes. Step four is basically profiting from the differential. You're earning, say, the higher Australian rate while paying the much lower Japanese rate on your loan.
Right.
Plus, if the Australian bonds or stocks you bought also go up in value, well, that's gravy.
Nice bonus.
Then finally, step five, realizing the profit. To lock it in, you'd sell the Australian asset, convert the Aussie dollars back into Japanese yen. Repay your original yen loan. And assuming everything went to plan, whatever's left over after transaction costs and, importantly, exchange rate changes is your profit.
Okay, that step-by-step helps a lot. The article had that yen-Aussie dollar example. Can you quickly run through those numbers again?
Sure. Let's say you borrow 1 billion yen, pretty standard institutional size, and the interest rate is super low, say P1.1% per year.
Okay.
You convert that billion yen into Australian dollars. Then you buy Australian government bonds yielding, let's say, 4% a year.
Much higher.
Right. So after 1 year, you get 4% interest from your bonds. You owe P1% interest on your yen loan. The difference is 3.9%.
Sounds pretty good.
It does. But and this is the crucial bit, that 3.9% is before you factor in any change in the value of the Australian dollar versus the Japanese yen during that year.
Ah, that exchange rate risk again. Sounds like the elephant in the room. We definitely need to unpack that.
Yeah.
But before the risks, what other things influence how profitable a carry trade might actually be?
Good question. The 2PI article listed several key factors. Number one, obviously, is that interest rate differential we keep talking about.
The core of it.
Absolutely. If that gap shrinks, maybe the high-rate country cuts rates or the low-rate country hikes rates, your profit margin gets squeezed or could even vanish.
Makes total sense.
Yeah.
Bigger gap, bigger potential profit, and vice versa. What else matters?
Macroeconomic conditions. Huge factor. Like, think about inflation.
Okay, how does inflation play in?
Well, say the high-yield country suddenly gets a spike in inflation. Their central bank might react by hiking interest rates even more to cool things down.
Which sounds good for your investment yield, right?
Initially, maybe, but higher rates often strengthen that country's currency. And if the Aussie dollar, in our example, gets much stronger against the yen because of those rate hikes.
Then when you convert back to yen to repay the loan, you get fewer yen back. It beats into your profit.
Precisely. It can seriously hurt your overall return. So higher rates aren't always a simple win. It's complex.
Okay. What about the general health of the economies? Economic growth.
Yeah, differing economic growth rates matter too. Strong growth in the high-yield country often supports higher interest rates, which is good. But if their economy weakens, the central bank might cut rates to stimulate things, and that reduces your carry trade earnings?
So you need the high-yield economy to stay relatively strong.
Ideally, yes. And then there's the direct actions of the banks themselves, central bank monetary
All
policy.
right, their decisions on rates, bond buying, all that stuff.
Exactly. Those actions directly hit both the interest rates and the exchange rates, the two absolute core components of the trade.
Okay, so economic fundamentals are key. What about non-economic factors? The article mentioned the political situation,
Yeah, definitely. Political instability, think big elections coming up with uncertain outcomes, maybe risk of coups, or even major geopolitical conflicts.
like wars or trade disputes.
Right. All that stuff creates volatility, uncertainty. And that makes carry trades way riskier. Investors tend to flee risk in those situations, causing sharp, unpredictable currency swings.
Markets hate uncertainty.
Hmm.
Makes sense. What about broader economic policy, not just interest rates?
Good point. Changes in things like capital controls, rules about moving money in or out of a country, or sudden changes to foreign exchange regulations can completely block a carry trade.
Right. If you suddenly can't get your money out, the whole strategy collapses.
Totally. And then, back to our big one, exchange rates
A
themselves.
main event.
Pretty much. Even if the interest rate gap looks fantastic, if the currency you invested in tanks against the currency you borrowed, well, those exchange rate losses can wipe out all your interest rate gains. You could end up losing money, big time. This is almost always seen as the single biggest risk.
So you could be earning 5% interest, but if the currency drops 10%, you're still deep in the red. Ouch.
Exactly. Then there's market sentiment, the overall mood.
How does crowd psychology play in?
Well, investor psychology, overall risk appetite, it really affects currency values. In scary times, globally, investors often run for perceived safety.
Like US dollars or Swiss francs?
Or, ironically, sometimes the Japanese yen itself, even though it's often the borrowing currency. So a risk-off mood globally can mess up carry trades.
Okay. And one last one the article mentioned. Counterparty risk. What's that?
That's basically the risk that the institution you're dealing with fails, like the bank you borrowed from goes bust or the place you invested your money defaults. It's the risk your partner in the transaction doesn't hold up their end of the deal, could lose your capital that way.
Okay, wow. That's a lot of moving parts influencing whether this works out. So let's really focus on those downsides now.
Mhm.
The article listed 9 specific risks. Let's tick through them. First, interest rate change risk.
Yeah, this is fundamental. If the central bank where you borrowed cheap, like Japan, suddenly raises rates, your borrowing costs go up, squeezes your profit margin right away.
Makes sense?
Or, conversely, if the high-interest country, like Australia in our example, cuts its rates, your investment earnings drop.
So changes on either side hurt you.
Right. And that Bojay hike example we used, that's exactly this risk in action. Rates nudge up in Japan, the yen carry trade looks less good, people sell assets, buy back yen.
Which pushes the yen up and asset prices down, compounding the problem.
You got it. It shows how interconnected these risks are. A small rate change can trigger effects across multiple risk factors. It's a delicate balance.
Okay, so rate changes are a big one. Number 2, inflation risk. How does that work again?
Right, so if the high-yield country gets hit with high inflation, their central bank might hike rates aggressively.
Which strengthens their currency.
Often, yes. And that stronger currency, as we said, can hurt you when you convert back to your weaker, low-rate borrowing currency. So inflation indirectly creates an exchange rate problem for the trade.
Got it. Inflation leads to rate hikes, leads to potential currency pain. Okay. Third risk, economic growth risk.
Yeah, we touched on this. Strong growth in the high-yield country is generally good, supports higher rates.
But if their economy tanks,
If it slows down a lot or goes into recession, their central bank will likely cut rates to try and boost things. And lower rates mean lower earnings for your carry trade.
so a weak economy in the investment country is bad for your returns. Okay. Next, monetary policy risk. How's that different from interest rate risk?
It's closely related, but it's more about this surprise element. Unexpected announcements or sudden shifts in policy from a central bank can really shock the markets.
Ah, the unpredictability.
Exactly. That Bojay move on July 31st, 2024 that the article mentioned, that was seen by many as a bit of a surprise, and it forced investors to quickly rethink and potentially bail out of trades.
Right, central bank surprises can really derail things.
Yeah.
Okay, number 5, the big one you flagged earlier, exchange rate risk.
This is the killer, potentially. If the currency you invested in, the Aussie dollar, falls in value against the currency you borrowed, the yen, that loss from the exchange rate alone can completely erase your interest rate profit. Or worse.
Or much worse, lead to significant losses. Imagine borrowing stable US dollars to invest in a high-yield emerging market currency. If that currency suddenly plummets against the dollar, you're facing a big loss when you convert back to pay your USD loan.
Yeah, trying to predict currency moves feels, well, really hard. Like predicting the weather, maybe even harder.
It's definitely challenging. There are just so many factors, some completely unpredictable. That's a huge risk for anyone thinking about this.
Understood. Okay, number 6, credit risk.
This relates to the perceived riskiness of the country you're investing in. If a country has high credit risk, meaning markets think there's a higher chance they might default on their debts,
Uh,
their interest rates might be high partly because of that risk to compensate investors. But that same high risk can also make their currency more volatile or prone to depreciation.
so a super high yield might actually be a red flag for currency instability.
It can be, yeah. It's
Yeah.
not free money. You're being paid to take on that higher perceived risk, which includes currency risk. Makes sense. Seventh risk, political and geopolitical risk.
We touched on this too. Political chaos, wars, major international crises. These things cause massive uncertainty and can lead to sudden, sharp currency moves. Carry trades are just exceptionally vulnerable during times like that.
Right, global events can throw everything off course fast. Eighth risk, liquidity risk.
This is about being able to actually trade when you need to. In really volatile markets or during a crisis, the normal buying and selling in the forex market can dry up.
So you might get stuck.
Yeah, you might find it hard to sell the currency you hold or buy the currency you need to repay your loan, at least not at a decent price. You can get trapped in a bad position, making losses even worse because you can't get out easily.
Okay, so even if you decide to cut your losses, you might not be able to. Nasty.
hmm
And finally, number 9, market sentiment and volatility.
This is the overall mood music. Global markets react strongly to surprises, economic data, political events, even natural disasters.
Mm.
Often this leads to a flight to safety. Investors dump risky assets and buy things considered safe havens.
Like gold or the yen again.
Ironically, yes. So a sudden shift to risk aversion globally can hurt carry trades as money flows out of the high-yield currencies and potentially into the low-yield borrowing currencies like the yen. It disrupts the whole logic.
Wow, that is quite the list of potential pitfalls. It really hammers home that this isn't some easy money scheme. It requires serious understanding and risk management.
Absolutely. It's definitely not for the faint of heart or for anyone who doesn't have a very, very solid grasp of global finance and risk.
So, given all those risks, when would it even make sense to consider a carry trade? What are the, I guess, ideal conditions, even though it's still risky?
Well, the 2PI article really stresses extreme caution, deep understanding of macro trends, exchange rates, and solid risk management. But if you were to consider it, generally you'd want a situation where you expect exchange rates between the two currencies to be pretty stable. Or even better, you have a strong, well-reasoned expectation that the high-interest currency will actually appreciate against the low-interest one.
So, confidence in currency stability or movement in your favor. What specific conditions might look ideal?
Ideally, you'd want stable economies in both countries involved, clear, predictable monetary policies from their central banks, no major global shocks or volatility expected on the horizon.
A nice, calm pond.
Sort of, yeah. And critically, the low borrowing rates need to look like they'll stay low for a while, and the high investment rates need to look like they'll stay high. That differential needs to persist.
And being able to accurately predict or at least have a strong thesis about those exchange rate trends seems absolutely vital.
Paramount. Utterly crucial. Like we keep saying, if that high yield currency drops unexpectedly against the borrowing currency, it can just demolish your profits. Your currency forecast has got to be solid.
And the article mentioned trying to manage risk through diversification.
Yes, that's standard practice for sophisticated investors. Don't put all your eggs in one currency pair basket. Spread the risk across several different carry trades involving different pairs.
Makes sense.
And maybe diversify beyond currencies too. Other assets like stocks, bonds, commodities. It helps spread the overall portfolio risk.
And constantly watching the markets.
Oh, absolutely. You need to be monitoring forex movements, macroeconomic news, central bank signals constantly. Be ready to adjust your strategy, maybe reduce your position size, or get out entirely if risks spike or the landscape shifts significantly.
Very active management required then, not a set and forget thing at all.
Definitely not.
Okay, let's shift gears a bit. Talk about history. The article mentioned carry trade bubbles. When did this strategy really become a big deal globally?
Well, its roots as a major force really go back to the 1990s. Japan had its massive real estate bubble burst in the late 80s, early
Right,
90s.
the lost decade started.
Exactly. Japan entered this long period of economic stagnation. To fight it, the Bank of Japan slashed interest rates, eventually getting them down near zero.
Creating that cheap pool of yen.
Precisely. And that flood of cheap yen looking for better returns elsewhere became a huge factor. Some economists, like at the IMF, even argued that these massive yen carry trades contributed to the imbalances that eventually led to the 2008 global financial crisis.
Wow, a link to the '08 crisis.
Yeah.
That's significant. A serious warning sign about potential systemic impact.
It is. And things got even more extreme later. Remember, we mentioned negative rates?
Yeah, in 2016,
Right. The BOJ actually went negative. Meanwhile, post-COVID, many other central banks started hiking rates to fight inflation.
widening that interest rate gap even further.
Massively, which made yen-funded carry trades look incredibly attractive again, led to this huge outflow of speculative money from Japan hunting for yield.
Where did it go? The article mentioned Latin America.
Yeah, that was a key destination. Countries there often have much higher rates than Japan, Europe, the US. And between 2022-2023, places like Brazil, Mexico saw their currencies surge. The article cited returns of like 40% for yen borrowers investing in Mexico.
40%, that's astronomical. But doesn't that kind of return scream high risk? Is that sustainable?
That's the billion-dollar question, isn't it? Those kinds of returns often reflect significant underlying volatility or risk. It rarely lasts forever. Which brings us to the more recent shifts in 2024.
Right, things started to change.
Yeah. Early July 2024, the yen started strengthening a bit. That spooked some carry traders. They started taking profits, buying back yen.
Which pushed the yen up more. A feedback loop.
Exactly. Then came the BOJ's surprise rate hike to 0.25%. Tiny but symbolic. Add in worries about the U.S. maybe heading for recession, meaning potential cuts to U.S. rates.
And suddenly the yen looks relatively more attractive, or at least the carry trade less compelling.
Precisely, the whole dynamic started shifting.
And the Japanese stock market took a hit because of this unwinding.
Big hit. August 5th, 2024, the Nikkei dropped over 12%. That rattled cages.
I bet.
The BOJ deputy governor then had to come out and try to calm things down, saying, probably no more hikes immediately until things stabilize.
Did it work?
Markets did stabilize a bit. Reports suggested hedge funds started scaling back their bets on the yen rising much further. But the whole episode showed how sensitive things had become.
So, kind of a roller coaster for the yen carry trade recently. The TOPI article seemed to conclude that maybe the easy days are over, with more volatility expected.
Yeah, that was the sense. And it included that quote from Jack McIntyre at Brandywine Global.
What was that again?
He said, "No trade lasts forever. The reality has changed. BOJ is tightening and something has to break. In this case, it's carry trade."
Something has to break. Powerful quote. Really sums up that feeling of a potential turning point.
I think so. It captures the idea that the long era of ultra-cheap yen fueling these trades might be ending as Japan's policy finally starts to, normalize, even slowly.
So the TOPI article's final advice was basically, be careful, do your homework, especially now.
Pretty much. Caution and thorough analysis are crucial, especially with the current uncertainty and potential for more volatility ahead.
Okay. That definitely paints a vivid picture. A strategy with big potential rewards, but loaded with very real, potentially very large dangers, especially as the whole global economic picture keeps shifting. So let's try to bring it all together for our listener. What's the single most important takeaway from this deep dive on carry trade?
I think the absolute key message is this. Carry trade can offer profits from interest rate differences. Yes. And it's a big but. It comes loaded with significant, often unpredictable risks, especially exchange rate risk and risk from sudden policy changes. It's not free money.
And the yen, the king of funding currencies for so long, its reign might be facing some challenges now.
It seems that way. Those recent BOJ moves, however small, signal a potential shift. It just highlights again how interconnected global finance is.
Right.
Events far away, policy shifts in Tokyo, they can ripple out and affect investment strategies everywhere, even if you're not directly trading currencies yourself.
So for our listener, understanding these global links is just becoming more and more important, regardless of what they invest in.
I'd say so, yes. You need to be aware of these bigger currents.
Definitely food for thought. Okay, so here's a final thought to leave you, our listener, with. Central banks everywhere are doing this tricky dance right now, fighting inflation, trying to support growth. In that kind of environment, How do strategies like carry trade evolve?
Hmm.
What new opportunities might pop up? Or maybe what new hidden risks might emerge for investors as this global landscape keeps changing? Maybe think about what those interest rate gaps and currency swings mean, not just for big hedge funds, but for your own understanding of the global economy and potentially your own financial picture.
Very important questions to ponder.
Indeed. Thanks for joining us for this deep dive. We'll catch you next time.